Welcome to the How Did They Do It Real Estate Podcast. Have you ever wondered how people succeed in real estate and what steps they took to get there? If so, this podcast is for you. Your hosts, Sayla and Eileen Prack, interview top experts in the real estate community to share with you their real estate journey and how they achieved massive success. Our goal is to provide you with valuable real estate resources and to help you apply it to your own real estate goal. Welcome, everyone, to today's episode of the How Did They Do It Real Estate Podcast. I'm your host, Eileen Prack, and today we have a fantastic guest for you, Tracy Hubbard. And Tracy is a real estate investor, syndicator, professional Forex trader, and serial entrepreneur, having owned and operated 6 companies across various industries. He's had over 20 years of experience in the financial sector as a professional commodities and Forex trader and investment fund manager, previously holding Series 3 and 43 licenses. And because of his extensive experience in the global interest rate and currency markets, he brings a unique advantage in his understanding of how global interest rates can affect cap rates and financing rates, giving him the edge to position his investors for the coming years. He's also a father and grandfather as well. We've had the pleasure of having his daughter, Keely Hubbard, as a guest on our podcast. And so we are so grateful to have you on the podcast as well, Tracy. Welcome to the show.
Thank you so much for having me, Eileen. I appreciate it. You did say something just then that, and I know it was probably a mistake. You said I have expensive experience in the markets, and you probably meant to say extensive, but I will tell you that it was expensive. So that you were correct when you said that. It was an expensive experience at that time. Yes, it was.
Extensive and expensive experience.
Yes. And I'm sorry, I didn't mean, you can go back and edit that
out. Thank you.
When you said it, I thought, that's pretty profound. Actually, it's pretty true. So,
but Tracy, no, I really appreciate it. And I would love to hear a little bit more about your background as well and what made you get started especially in real estate.
Sure. Well, because as you mentioned, I've got 4 kids and I'm a grandfather, so I've got a lot of experience in life, and because I'm part of the boomer generation. So I'll give you a little background on myself as sort of the shortest version I can. I'm a native Texan, 6th generation, been here forever and will stay here forever. I'm a former United States Marine, and that sort of helped form a lot of my, I would say, can-do attitude and risk tolerance going forward in my life as part of what I did. When I got out of the Marine Corps, I went pretty much almost directly into entrepreneurship. And through my entrepreneurship through the 80s and 90s, I owned, like I said, several companies. One of them bankrupted me. And so I had the unique experience of being able to start over in life, and when I was 42 years old. So not by choice, but it was by, the way it happened. And when I say bankruptcy, it wasn't one of these, okay, let's just, file bankruptcy and wipe out my debt and start up, another company down the street. It wasn't, we were broke. So it was a very tough time in our lives. I think it was probably one of the greatest things that could have happened to me and for my children, as far as them to understand where value lies and as far as the family and stuff like that. That's, when I look back on that, my biggest concern was, that my kids might look at me as a failure. Kids, they don't care about that. They just want to know that the family is a unit and stays together no matter where you're at and what happens. And so that was a very, very great time in our family's life as far as what it took us to. But that opportunity had me evaluate my life as far as what I wanted to do. And from there, I started looking into the financial markets. It's sort of interesting when you're an entrepreneur and you have issues or whatever, or troubles, and you may want to go out and just say, I'm just tired of this. I need a job just so I can feed my family. It's hard to find a job when you're an entrepreneur like that, because everybody looks at you and say, well, you've been doing this, your whole life. I don't want to hire you. You're going to come in here and watch what I do and start up a business in competition. That's the kind of thing you face or you go into, or that they say, well, you're overqualified for this, or whatever. So I knew that I would have to make my own way in another way, pretty much relying on myself. So that's sort of when I got into the financial markets, and timing on that was really good. I got into them about in 2000, and then we had 9/11 hit. Which was a, pretty devastating time for the markets. When the markets shut down, it was pretty tough. So I cut my teeth in the financial markets trying to learn how to make it work. And that took me about 7 years of trial and error. That's where the expensive experience came in, was the trial and error part, learning how to trade. But then I got pretty good at it and started trading the financial markets, and then eventually started managing some small funds, hedge funds along those lines. That went very well for several years. Then we had the 2008, 2009, what we call the housing crash. And when that happened and the market crashed, everything changed from that point. All the central banks of the world, the Fed and Bank of England and the European Central Bank and the Bank of Japan and all the big banks started racing to the bottom. As far as when I say racing to the bottom, to be able to stimulate their economies and save them, they started lowering their rates, going towards the zero. And when that happens, it does stimulate the economy, but it also makes it a little bit crazy and volatile. And it became harder and harder to make money in the trading world, especially when you think of currencies. And I did a lot of currency trading. Think of a currency, say the US dollar, it is like the stock of that country, whereas the euro is like the stock of the European Union. And same thing with the British pound for the Bank of, for England. And the Japanese yen is for the bank, for the country of Japan. So to be able to make money trading currencies, you're basically trading differentials of the interest rates. So if the main Fed rate is, 5% for the US dollar, but yet it's 0% for the Bank of Japan, well, there's a big interest rate differential there, and you can make money trading those difference. Well, if everybody's going to zero, there's no differential anymore. And so it became harder and harder to make money in trading the financial markets. And as I became more difficult to get a better return for my investors, I thought, I'm going to have to find out another solution to this problem. And then the next thing I saw was just how the markets were very, very manipulated after the Fed started getting so heavily involved in 2008 and 2009 going forward, to where it was not a level playing field. So I said, okay, where do I want to put my money? Because this is a house of cards that I was very concerned about when it does collapse, and nobody knows when. I just didn't want to be a part of it. So where's a store of wealth that you can put your money is hard assets. Well, hard assets are usually commodities and real estate. And when I say commodities, I'm talking not the futures market on, interest rates and stuff. I'm talking about the hard commodity itself, with that grains, gold, precious metals, gas, oil, all those kind of things. And then real estate being what I would consider the ultimate hard asset to own. So that's when I started looking heavily into real estate. That was back in 2016. Is when I started moving over into those hard assets. I'll take a break now.
I mean, in one person's lifetime, you are able to have not only extensive, but also expensive experience in the financial markets. I want to kind of go back a little bit. When you went bankrupt at that time, what were some of the steps that you had to take, like immediate steps that you had to take to be able to get yourself back up to become successful later on in the future? And then how long did that process take for you to feel comfortable again that you've stabilized your situation financially?
That's a great question. And I'd like to say that I'm a very positive person. I will say that, probably too positive and too optimistic sometimes. That can get you in trouble as being, pessimistic. Well, you can also be too optimistic. But I'm a very positive person. So you would think I could have bounced back from that pretty quickly. But I'm telling you, it was tough. It was tough physically and emotionally. I would say the biggest reason I was able to do that is I have a great partner in life, my wife. We've been married, over 40 years. We were high school sweethearts. She was the stability there that I needed to be able to get myself together. Because I'll tell you, I sort of went into a funk, into a depression after that. And she sat me down once and said, what are you doing? And, I'm sitting there having a pity party. And I said, well, what do you mean? What am I doing? What am I doing today? Do you need some errands run? That kind of stuff. She goes, no, what are you doing with your life? Because this is not who I married, and you're not that person. You need to know who you are and be able to get up and just move forward. And so she basically, did that snap me out of it kind of thing to help me get back into the game, as I say, get back in the game. So that was the big key there, was having someone there to help lift you up and be there when you can't be 100%. And it's sort of like parenting. One of you always has to be on, or available. Maybe you can't all both be there at the same time, but one of you had to be able to pull the weight if the other one can't. So that was the key there. She gave me that motivation and the confidence to know that I could recover from this and start doing it. So that's what I did. And I will say that I had some friends that came in, and said, hey, I will back you again if you want to go into business again. I go, but at that time, I was pretty much done with owning businesses. I didn't want to deal with it because everything with owning a business is, it looks really glamorous. If you've never owned one, it looks, okay, this is the greatest lifestyle in the world. But I will tell you, I used to have this on my wall in my office. It says, the only thing more overrated than natural childbirth is owning your own business. So, and most women can identify, I can't identify with that, but my wife could. And she goes, oh, yeah, that's great. Oh, well, no, it's not really that great. So, owning your own business is not always super. And it's what I've always told entrepreneurs. I said, until you put payroll on an American Express card, because you've got to pay your employees first, you've not been in business. So, it's been those kind of things. So that opportunity to go back into business, I sort of passed on. I said, I'm done with that. I don't want to deal with all the things you have to deal with a business at the time, because I spent more time dealing with, OSHA, the IRA, the EPA, all the regulations. And if you have a lot of employees, which I did, you're pretty much their counselor, their banker, their bail bondsman. It's whatever they need. They usually come to you first. So I was a little burned out on that. So I didn't really want to own another company again. So that's why I sort of got into trading, because that was something that I could do on my own that would produce results. If I was not good at it, all I had to do was look in the mirror, and that's who to blame. So that's pretty much how I started doing that. But I will say that I did take a couple of jobs in the interim just to be able to feed our family. I had to have some income coming in. So I did have a friend that had a company that had some background in some of the business I'd owned. So I went in there to help him turn some of that around and manage it for a while before I went into full-time trading.
And so fast forward now, when you're in real estate, looking at those different commodities to invest in, and started back up in 2016, what did you do in order to get started on that side of things? And how did you build it up? And what was the market like at that time versus fast forward to today, what the market looks like now?
Right. And this will sort of dovetail in what you were asking me about, what I wish I knew now versus then, when I started getting into real estate. So I wanted to get into real estate. I knew a little bit about real estate. I'd done some industrial warehousing, real estate sale leasebacks back in the late 80s and early 90s. So I understood the real estate vehicle and how well it worked. But I knew I didn't want to get back into industrial at the time. It really wasn't that great of a market. So I immediately started looking at different assets within the asset itself, which would be single family rentals, mini storage, RV parks, all that kind of stuff, and then multifamily. So, and I settled on multifamily simply because I didn't want to have to be the guy, changing out a water heater on a house, at 2 a.m. So I said, I don't want to do that. So I'll get a multifamily apartment. So I started educating myself on the multifamily asset class within the real estate, and realized that's where I wanted to be. The mistake I made was, I could have bought on my own probably, a multifamily unit, with 20 units or something like that. Well, that sounds great, but then I'm done. I've done everything. I can't do any more because I'm out of cash, or what, I'm pretty much leveraged as much as I could get. So that's when I finally realized, okay, I need to scale. To be able to scale this, I need to start doing syndications. And so I didn't really know a lot about the syndicating world at that point. So I had to educate myself on the syndicating. And those processes took me, a couple of 2 or 3 years in there to figure all that part out. So, but then I ended up settling in on syndicating of multifamily and bringing in partners, and something else that was new to me, because everything I'd done in the past, I did not have partners. All my businesses were pretty much just me, and my wife was my partner. So I didn't like partners. I didn't want partners. So I guess my mother probably could have said he doesn't play well with others when he was a child. So maybe, I don't know. But anyway, so basically, maybe I'm a control freak. I don't know. But that's why I didn't have partners. So, but that's what I had to realize. Okay, if I'm going to do this, I'm going to have partners on this. And that's when I realized, it's a lot better to own a piece of something very big than all of something really small. So that's sort of how I morphed into that part of it. And that was started happening in 2017 and 18.
What do you think shifted your mindset from not wanting to play with others to now partnering with other people to move forward in business?
Diversification. I didn't know a lot. I learned a lot about diversifying. When I was owning my businesses, they were all owned by myself, but I did know through trading the markets, I learned how you can be diversified in different markets. So if you're in different asset classes, or let's say if you're trading a stock, well, maybe you're in an energy sector. Well, you need to be in something besides the energy sector, because if you own Exxon and Marathon and Chevron. Well, if something happens in the oil sector, you're losing on all three of them. So that's not being diversified. So you need to be in different types of market that will hedge yourself against one another. And that's pretty much the way it is when you're going into real estate as far as a partnership, where you're going to have to bring in people that are good at what they do. Because, and I don't profess to be, the best of everything, but I do have skill sets that I can bring to the table. And maybe as an asset manager or looking at financials and underwriting, but maybe I'm not the best person for people. Maybe I'm not the best people person. Too much of my Marine Corps background comes in, and people, they don't want that part of, they don't want that. That's a little too harsh for them sometimes. So I learned that you need to bring in people with their skill sets and make sure that everybody has their role and they stick to their roles, and that I had to realize, there are other people that are better at the stuff than I am, and I need to utilize their skill sets. And some of them turn out to be my kids, by the way, that I brought in as partners that are much better than I am at some things. And so that's how I ended up partnering with Keely, on my daughter on a lot of our stuff that we're doing. So that happened. And that's how I ended up getting into syndicating and understanding that's the way to go.
In real estate now today, what we're seeing is a lot of volatility in the interest rates. Cap rates are compressing and continuing to compress. How are those two correlated in your opinion, and how you've seen the markets evolve over time? And do you see this trend continuing going forward? And what's the correlation to you?
Yes. Well, let's talk about this. Let's talk about the markets and cap rates. Here's something that people need to understand, because it's all over the news every day. The markets don't change quickly, and the cap rates don't change quickly, just like interest rates don't change quickly. They're not going to go from, 1% to 6% overnight. It's going to take them years to get there. Or, when I say years, it could be 2 or 3 years. Nothing's going to happen overnight. So it's a gradual process. And that's the same thing on cap rates, whether they're compressing, or expanding, cap rates don't happen that rapidly. Now, it is more supply and demand driven, the cap rates are, and they are driven by interest rates, which, it's sort of the effect there is interest rates go up. What's that going to do? That's going to start tightening lending up. And maybe not just in interest rates, maybe they're not tightening the interest rate as much, but let's say instead of doing a 75% loan to value, now they're only doing 70 and 65%, which means what? Now you got to raise more equity, which means you have more money invested. So the return is naturally going to go down, what you're going to get your return on, because you have more money invested for the same amount of return. So your return on your investment's lower. So that's how that's going to affect it. But like I said, it doesn't happen overnight. And you just sort of need to project out where you're going to be and what the environment is. Now, the environment right now in the multifamily world, in my opinion, and you have, you have a major compression of cap rates over here in the last couple of years. And they may not be quite as bad now, but there's still a seller's market. And for me, because I just sold a couple of properties last month, and it wasn't something we planned on doing, but an offer was brought to me simply because how fast the market's changed. And I didn't even own this thing a little over 2 years. And so if you start hitting your target, just saying, okay, can this continue going? Well, probably not at this pace, no. And you got to look forward and say, okay, what do I need to do with this property? Well, I'm going to have to refinance this property in a year. Well, where interest rates going to be in a year? I don't know, but they're probably going to be higher than they are now. So is that somewhere I want to be in a year to take that? Will that be able to give me the profit, or can we get the majority of the profit right now? And so we made a decision, let's go ahead and sell this right now. As we say, keep our powder dry to be able to buy something else when it appears. Now, right now, it's harder for me to find properties to buy. Now, don't get me wrong. I've never seen so much activity out there in the world and I'm glad there's activity, because I wouldn't be able to sell mine if there wasn't. But it's harder for me to find something that my investors will get or want the kind of return they're looking for. I think investors are starting to have to understand it's going to be harder and harder to get that, say, 10%, cash on cash per year, and 100% return in 5 years. I'm not saying they're not out there still, but they're harder and harder to find, and the competition's harder on that. So whenever I see something like that, I always would love to see the underwriting on these things, because as we all know, spreadsheets can say whatever you want them to say. And I think a lot of investors out there right now in the multifamily world are banking on appreciation and compression of cap rates and rents just keep going up, 5 and 10% a year. They're banking on that to get them out of the hole down the road, and not say out of the hole, but to be able to hit their numbers is what I would say. I have a saying that says, appreciation covers lots of sin. So you could have done a really terrible job of underwriting and overpaid for it, but if the market goes up, well, hey, you're a hero. It's just like people who think they're brilliant traders because they bought in the middle of a bull market. Well, they're not. They're just timing, and usually it's by accident. It doesn't make them a great trader. If they haven't gone through 2 or 3 market cycles, it doesn't mean squat to me, because unless you've been through it, you think you're a genius. So it doesn't fly. So I don't know if I answered all your questions on that or not.
No, yes. Thank you. Thank you. So I'd like to follow up with a question. If the equity needed to purchase the property is starting to increase, returns for investors are starting to come down a little bit more from what they're typically expected to receive in the past, why would investors still look at real estate as a good investment opportunity for themselves if they're not getting the returns that they had previously experienced?
You have great questions. These are great. It's almost like I could have paid you to ask me these questions, because it's so profound. Because why would you invest in something if you can't get your greatest return? Well, instead of getting, maybe you're not getting your 8% pref, maybe you're getting 7 or 6. And, maybe the cash on cash is 7%. Well, that's still great. It's still good returns. It's what people aren't used to. So they've got to get understanding that this is the new environment we're in. But what hasn't changed is there's nothing better in the world as far as depreciation and tax benefits as real estate. So that's why people will still do it. They'll still put their money in the deal because they get those massive tax benefits. And it's the same way I'm looking at it, because it's sort of funny if you're in the real estate business and you get your K1s with all these big negative numbers on it, and you send them let's say you send them to a regular mortgage broker, because I'm in the process of getting ready to do some stuff on buying a house. Well, they want to see your tax returns, and they say, how do you live? Because according to this, you don't make any money. So I go, well, this is legally the way you can do this. So they explain that to someone who doesn't understand how real estate works and capital gains and stuff like that. It's hard to explain to them, because I don't have a W-2 income. So I don't have a 9-to-5 job that I can show you, here's my pay stub. And so to explain something like that is hard to do. But bits of owning real estate are massive. And I don't think the Congress will ever, they talk about it, but I don't think they'll change a lot of it, because there's so many millionaires in both, the House and the Senate and everywhere. And a lot of it's because of real estate. So they're not going to shoot themselves in the foot on that.
I appreciate all the insight that you gave just now. I think it's really profound. And I'm excited that, that it's still a great place to, at least in your opinion as well, looking at real estate as being some place to still getting those tax benefits, those depreciations as well, to apply to your own situation. But I kind of want to ask a personal question, if you don't mind as well.
Sure.
Because earlier you had talked about the mindset where you were going through that bankruptcy, but the thing that helps you get through it all was having a strong partner in your wife to be able to lift you up and pull you out of that dark space and to help you propel moving you forward. Just purely for selfish reasons, I want to ask, what makes it a successful marriage for you and your wife that you have been able to establish such a strong bond between each other?
Well, she's sitting over here about 5 feet to my left. I ought to bring her in.
Yes, please do.
Hey, get up for a second. So she'll probably get mad because she didn't think she would be on camera, but come around over here. So I'll have her look.
Hi.
I'll have her.
Hi.
It's nice to meet you.
It's so nice to
Move
meet
up a
you
little bit
also.
There, I'm trying to get you from being blurry. Here, we'll move on in here, honey. I'll get out of the scene a little bit there.
I'm still blurry.
There
Here
you
we go.
So,
Anyway,
yep.
I would say, and I just want people to be able to see her. So as you can see, if you see my kid, they're great looking kids. They got all her looks. That's what it was. So I'm very fortunate from this. Always marry up. That's what I would say. And I will say the biggest part would be communication, I guess, is what I would say to make for the strong marriage. Now, I will sit here and tell you that that's not my strong suit either. So my wife, Katie, is definitely a great communicator, and she's known for it in all the circles she runs with. She's an author, so her life is all about words, and she's a great wordsmith. So Communicating is great, but you've got to be able to do it. So she has to, sometimes, it's like pulling hen's teeth, as they say, to get me to open up or talk about stuff. So that's what it is. You got to be communicate, because it's one of those things, and that sort of goes forward too. And I want to sort of parlay that into what we do in our real estate stuff. Communication is key, because everybody has expectations, and everybody comes into a marriage with expectations. Now, we probably didn't. We were young kids when we got married. Our expectations were not probably realistic, but you have expectations. And so if that partner doesn't meet that expectation, it's usually because they didn't know you expected that, or you're not fulfilling whatever you said you would do. So that's important that you understand, okay, what's going on. And that's, like I say, that's not my strong suit. The Marine Corps pretty much, it did a number on a lot of stuff for me as far as being, and I think I'm a compassionate person, but my wife would tell you that I lost a lot of compassion when I was in the Marine Corps. Maybe it's because of some things you go through, but the older I get, the more compassionate I've been, and just in things in general. It's just, I don't know what it is, but, I can't, it's like watching a Lassie movie. I can't do that anymore because it makes me cry. So but things change as you get older. But I'd say the communication, and that's the same thing on the real estate side. And because that's not my strong suit, that is something that my daughter Keely is very good at also. And so communicating with our investors is critical, very critical. A lot of people buy a property and they throw it out there, and then you never hear from the general partner team as far as how are things going. And that's not good. You need to communicate with them, especially if things aren't going the way you want, and after some of the things we've come through in the last couple of years with COVID and stuff that have caused some issues in the real estate market, you're going to have problems. Well, I think people can deal with problems. What they don't like are surprises. And that's sort of what I tell my property managers. I can handle bad news. What I can't handle is surprise news, especially if you knew this was coming and you didn't tell me. Mm-hmm. So communication's key.
No, fantastic. Thank you so much for sharing that. And how has real estate investing impacted your life from, back in the day to where you are today now? How has it impacted your overall life?
I'd say freedom. You can also say freedom of time, but it is time consuming. The thing about it is, and I work out of my house, or wherever my computer is. That's pretty much where my office is. So it can take a lot of time throughout the day, and I may work on some in the morning, some in the afternoon, and some in the evening. So you say, well, that's not freedom. Well, it is, because I pick and choose the time and also the place. So, I can travel and work, be whatever I want to be involved with the family when I want to be. It's even more freedom than when I own my own business. So, because lots of times when you own your own business, all you've done is bought yourself a job that you have to be there on. So real estate's a little bit more free from that standpoint, simply because, obviously I don't have to visit every property every day, but, and so I can check on these things, but I'd say it's the freedom, and there's lots of financial benefits to it, but the money is not it. It's the freedom of time to be able to do what you want to do with your life.
And another question for you, because Keely mentioned about your dad jokes, and I love dad jokes. And so I would love if you can give us maybe top of mind one dad joke that you can think of.
Okay. How about, you know how you can tell a dad joke?
No.
It's apparent.
Oh, yes. Oh, yes. Hi, yes.
It's bad. So
awesome.
It should be apparent. So anyway.
Awesome. Well, Tracy, I so appreciate coming on the show today, sharing your story with us, all of your insight. You have such immense experience in this space. So I'm glad that we got to deep dive a little bit, pull a little bit from your brain. And I'm so grateful that you've been able to share all that with us today. And for our listeners out there who are also interested in reaching out, finding more about what you're doing in the space, where's the best place that they can go?
I would go to hubbardcapitalgroup.com. And we talk about everything we're doing in there, from multifamily, and we're also doing agricultural, because back to that diversification stuff. I love the real estate asset class, but there's different asset classes within that. So we're also branching off into vineyards and timber projects, believe it or not. So
fantastic.
We're all over the board. So
awesome. Well, thank you so much again for all of your time today, Tracy.
Thank you, Eileen. I appreciate it so much. And it was very enjoyable.
And thank you for listening to our podcast today, brought to you by Bonavest Capital. We would really appreciate it if you can go to iTunes right now and leave a rating and written review. Also, please don't forget to subscribe so you can always get the latest episodes. You can also connect with us on Facebook, How Did They Do It Real Estate. We'd love to hear your feedback and any topics that you're interested in for future episodes. Lastly, to learn more about us, you can go to bonavestcapital.com and fill out the Contact Us page so you can speak to us directly. Nothing on the show should be considered as specific personal advice. Please consult your legal, tax, and real estate professionals for individualized advice.